My name is Cornell Clayton. I'm the director of the Thomas S. Foley Institute here at Washington State University. And on behalf of the Institute, I want to welcome you out to our symposium this afternoon on financial and banking reform. I want to begin by thanking our co-sponsors of today's event. That's the College of Business. And in particular, I want to thank David Whidbey for helping us organize today's event and the panel today. I was just talking to my assistant director. Our very first symposium on financial and business policy at WSU was held 5 years ago. And that panel also focused on banking reform. Of course, that took place before there was any reform actually that had passed Congress, before the Dodd-Frank Act. And we had Brad Williamson, who was Rick Riccobono's predecessor, on that panel as well. So it'll be interesting to see what has happened in the 5 years since that time. We have a very distinguished panel today, and I've asked each of them to take about 15 or 20 minutes of comments, and then we'll open it up for questions and answers from the audience. I'll introduce each of our speakers in the order that they speak to us. Our first speaker is Jerry Kallberg. Jerry is the Alvin Wolf Distinguished Professor of Real Estate at Washington State University and a research professor of the Department of Finance at the Carey School of Business at Arizona State University. Prior to joining WSU in 2013, Jerry was professor of global finance and the director of research at the Thunderbird School of Global Management. And prior to that, he was a member of the financial faculty of the New York University School of Law and director of their PhD program in finance. Professor Kallberg is currently an associate editor of the Journal of Real Estate Economics, and he is on the editorial board of the Journal of Corporate Treasury Management. In addition to numerous publications, Dr. Kallberg has worked with the U.S. Congress and the World Bank on international banking and credit, and has been a consultant for a number of companies, including Goldman Sachs, Indian Railways, Morgan Stanley, Prudential Securities, and Prudential Real Estate. Professor Kallberg.
I'm not finished. I have more. Well, thank you for allowing me to be part of the symposium. I am going to have a relatively simple job. I'm going to lay out sort of historically some of the key points as what happened during the crisis, and then sort of set a groundwork for the more distinguished people to follow me and actually come up with suggestions as opposed to history. So the way I think of this is quite different than a lot of the crises we've seen. So every crisis is very different. That's why I think regulation is extremely challenging, because it's sort of, you're fighting the last war instead of the next war. So I'm going to talk about the housing crisis very briefly, the banking crisis which followed, and then what seemed to be less important was maybe the economic crisis, and then say a little bit about what might be going on now. I would recommend this book. It has one huge asset. It's free. It's 653 pages. This was the final report of the commission that looked at the crisis. It's a very distinguished group of scholars and government people who looked at all of the events and have very carefully cataloged it. And as you'll see, I've stolen a number of things from there. So it starts as a housing crisis. So if you look at the green line, it's a little hard to see in the brightness here, but this graph goes all the way back to 1952. I go back much further than that personally. But you'll notice from 1952 to the crisis, the actual nominal price growth was always at least zero in the United States. So the world had never seen prices decline the way they had done in 2006. And you also should see something interesting. If you look at the shaded lines which represent recessions, you'll see pretty well the housing prices fall after the recession, which makes sense, right? People have less money, people sell off assets, et cetera. And this crisis has the opposite. It actually occurs before and in some ways feeds into the recession that we saw in 2008. So if you look at that little box, you'll see stuff that in the lives of most of us had never been seen before. Huge losses in the housing sector. So why did that come about and what did that lead to? Here's a look at what it looks like right now, as a lot of this stuff is also stolen from the Freddie Mac annual report of 2013. This is the home price performance from the peak, June 2006, until the last data that Freddie has, which is September. And you'll notice the U.S. is far from having recovered that. It's 14% here in Washington. It's 13% below those levels And in the middle, in states no one's ever heard of, actually, like Kansas and Nebraska, those prices have actually recovered pretty well completely. The interesting thing, if you follow this more carefully, except for Illinois, the states in red are the so-called sand states. Those are the states where the most violent upturns occurred in the housing sector: California, Nevada, Arizona, and Florida. And that's where you can see they're still very far below the values, especially Nevada. Better way to look at this is to correct for a lot of factors that drive the housing and the rental market simultaneously. So this is a D-mean series going up to 2008. And what it looks at is a repeat sale index, which is correcting now for housing quality, against the rental ratio. And so the zero line represents the average. And you can see, again, if you go further back, this is really the biggest peak of all time. And that says something about how inflated housing prices were. Well, it's interesting that you people can actually borrow more cheaply than Pfizer. Pfizer has $32 billion in liquid assets, and in this room I would bet it's only Dean Whidbey that has $32 billion in assets. But the rates are remarkably low right now at 4.6. When I first got a house in 1980, I paid 16.5% interest, and those have changed very dramatically. That feeds a lot of what we saw, this declining rate. Here is U.S. housing stock, peaked at 2006. But the important line for us is the blue on the bottom, which shows the growth of mortgage debt. So mortgage debt basically is peaking at close to $10 trillion in 2008. So that is a huge factor driving all this. Here's another way to look at it. So forget about the boxes themselves and just look at what the circled numbers are. In 1985, the amount of debt that a consumer had relative to her house was 56%. So that's mortgage debt plus all of the other consumer debt, credit cards, home equity loans, et cetera, 56. And by 2008, that grew to 89%. So you're in a situation where the average homeowner really has no buffer for any declines in earnings, prices, et cetera. So we're going to talk about the mortgage-backed security machine, and what feeds that in this time was the subprime mortgage market. The way to think about the subprime market, you can think of it in different ways, but essentially it means the loans issued to people that had the bottom 25% of FICO scores, so that's roughly 620. And you can see that used to be, in the old days, 4 and 5%, it started to go to 10%, and by the time we got to 2006, that's almost a quarter of the whole market. And again, a sector that's very susceptible to any declines in housing prices. So there are lots of anecdotes about what's going on here. If you look at the top graph, you're looking at the combined loan-to-value ratios and how they deteriorate over time. So 2001, the standard of a 20% down payment is sitting there. And by the time we got to 2006, we'd lost almost half of that. And then the so-called no-doc, Alt-A liar loans, loans that had limited documentation. For example, they lacked documentation on earnings, which seems to be relevant to all of this. You see that growing to a huge 44% of the total. So Michael Lewis's book, which is quite amusing, The Big Short, it talks about a number of anecdotes. One he has is Bakerfield, California. Mexican strawberry picker with an income of $14,000 and no English was lent every penny to buy a house for $724,000. So students of Financial Management 325 can figure out it's kind of unlikely that those payments are going to be made in any timely manner. Better way to look at it is what's happened since then. So this looks at the last quarter of last year, and it looks at by origination date how many of these mortgages were either foreclosed or in a short sale situation. So if you look, for example, at the bottom line, that represents mortgages originated in 2003. By the 6th year, less than 1%, well less than 1%, were in foreclosure. The mortgages originated in 2007, we're looking at over 7%. Now clearly housing prices influence that, but it says a lot about the quality of underwriting and the deteriorating standards that we saw over that time. These mortgages, in the old days, the Royal Bank of Pullman would hold this mortgage. Now it would sell it off to various entities, private and government. So you can see that this stuff peaked very heavily in 2006 and has almost disappeared. So if you look at Fannie Mae, Ginnie Mae, Freddie Mac, right now, if you look at 2013, they are 90% of this origination. And if you go back to 2006 rather, you'll see that they were less than half. So it's very much a dislocation in the market for these mortgage-backed securities. It's a big market, right? So people don't exactly know a lot about the mortgage-backed securities if you're not working in this area. But it represents $8.5 trillion rather, as of the last quarter. So it's comparable to the size of the corporate debt market in the US. So it's a big market. 39 trillion instantly is like twice GDP, twice the market, the equity of the US. So here's very, very quickly how a mortgage-backed security works. In the old days, what would happen is, again, a bank would originate a mortgage and would hold it in its own portfolio. In 1970, people came up with a very clever idea of using diversification to pool enormous numbers of mortgages together. And then they came up with the other innovation, which was tranching, French for trench. And the idea would be, let's not have everyone who owns a piece of this pool treated exactly the same. So what's happening in this situation is you create a waterfall of revenues and perhaps of repayment. So the top tranche, let's say the top 20% in terms of value, would be getting paid first. The AA tranche would be getting paid next, et cetera, until you get down to the bottom, the so-called toxic equity tranche, which is an equity tranche often held by the originator. Now, that was fine, and that's relatively comprehensible. So one of the themes I think we have today is transparency, looking at the quality of assets and how easy they are, how difficult they are to value. So this basic asset is fairly easy to value. It doesn't create a problem for anybody. But what happens now is you create the collateralized debt obligation, which now takes essentially the bottom layers of this thing, which are, let's be frank, garbage, repackages them, and somehow out of all this garbage we create assets that are rated AAA. So another issue that we'll talk about today is, I guess, the quality of rating of these assets. Many of them are now in bankruptcy, and the AAA rating was basically not merited. So the idea was very simply take the worst of this pool, somehow believe the diversification still works, and you can create a AAA asset out of a pool of BBB assets, which is debatable. Of course, it gets even worse. Here's just very quickly an example. This is a synthetic CDO. So because this market demand for these types of assets grew very rapidly, you ran out of mortgages, so you created fake mortgages by the credit default swap on the bonds, which is synthetic. And one of the interesting ones is the Goldman Sachs Abacus. So if you look at the Goldman Sachs website, because of all the legislation, they have enormous detail about this particular issue. What was interesting is it is a set not of mortgages, but a set of insurance on mortgages. And John Paulson essentially was able to pick the portfolios that went into this and then short the asset, which is a pretty advantageous position. Goldman got in a fair amount of trouble for that. Paulson, however, made personally $3.7 billion in 2008, which is, as I say, that would be approximately Dean Whidbey's salary, which is very large. Now, part of the problem is transparency. So here's a picture of Abacus. Well, that doesn't look complicated, does it? It deals with various assets, counterparties in the swap, a collateral put agreement, a super senior, a protection buyer, a credit default swap, and credit events, et cetera, et cetera. So part of the problem with all of this, so here's another picture of it, this is called a partially funded synthetic CDO. So you have a super senior counterparty who essentially pays nothing, and then you have parties down here which have a tiny amount of capital. And these create enormous amounts of leverage, and perhaps more important for us, they create a great difficulty in determining the value of these assets. Now, students in my real estate class could figure this out very quickly, but for the average person, and certainly for a rating agency, this proved well beyond their capabilities. These assets were very hard to value. And the other problem was, seeing they're quite specialized, they didn't trade in very active markets like typical bonds. So the prices weren't established by market transactions, but rather by marks, meaning that we'd go to Goldman Sachs and ask, what would this sell for? And of course, he had incentives that would increase the value of their own portfolio by quoting values either higher or lower as they saw fit. So the thing to think about, though, back to the first diagram I had, it's really not a economic crisis, rather. There's a really minor downturn in GDP. I mean, GDP keeps rolling along pretty well. The corporate side continues to do really well. It's really constrained to the financial sector, and you see that blip largely because banks, well, partially at least, because banks stop lending at this point, and that contracts the economy. So 2008 rolls around. March, Bear Stearns fails because of mortgage-backed securities. September, Lehman Brothers fails, largely because of mortgage-backed securities. Fannie Mae and Freddie Mae, the biggest buyers of these mortgages, are put into conservatorship. The price drops from around $1.20 to $1, and now they're still, one of the issues that we'll have is what's going to happen to them. You have the Troubled Asset Relief Program. After that was initiated, I got an email from a colleague at Goldman Sachs who said, as soon as it came out, we actually called it the Bad Asset Relief Fund, Barth, which it took about 10 seconds for that name to be coined. Another book you should read, and I'm going to quote just a little bit from it here, is A Bird's Eye View. This is a book on the crisis. It's a couple of years old, but it's still pretty good. It's a very impressive group of people. Acharya, he's an ex-student of mine. Muriel Rubini, who is famous for what he did and all this. So that's a very good book. They have a couple of themes that emerge from the crisis, which is risk-taking incentives. So all of this is about incentives, and the risk incentives of financial institutions are wrong. There are implicit or explicit guarantees given to things like Fannie Mae, Freddie Mac, that we don't probably price properly. What a lot of these assets were is extremely opaque, difficult to price, and that created a lot of risk that we couldn't see very clearly. And then the problem we have is here, if a shoe store fails, we don't really care because it has no systematic risk. But the systematic risk of all of these financial institutions of this size is huge. So one example was when Lehman Brothers failed, one of the things the people taking over had to do was figure out the value of 900,000 derivative contracts, which take quite a bit of time, actually. A couple of other themes that they have, and let me just think about what they have, is sort of general outlines on principles. So the book is a little light on truly explicit kind of remedies, but it has a lot of fairly general principles, which I think are fairly important, is identify market failures, be efficient about the way you utilize all of the tools that regulators have, figure out a way of minimizing costs to taxpayers, and then government intervention should not create moral hazards. So one of the real issues here is, if you think of what Fannie Mae is, Fannie Mae was shareholder-owned, but charged with providing affordable housing to the United States. So you create a very deep contradiction in what they're supposed to be doing, and it's no surprise that we should create all these problems. So now you know every single thing I know about mortgages and real estate.
Okay, our next speaker is Richard Riccobono. Rick is the Director of Banks for the State of Washington's Department of Financial Institutions. His office examines and supervises state-chartered commercial banks, stock and mutual savings banks, foreign banks, savings and loan associations, and independent trust companies. Rick has spent over 25 years in the financial services industry as both a banker and a regulator. He most recently served as President and Chief Executive Officer of the Federal Home Loan Bank of Seattle. He has also served as a regional director, a deputy director, and acting director of the Office of Thrift Supervision in the U.S. Department of the Treasury. Rick started his career in public accounting, and he is a member of the Georgia Bar Association and the Texas State Bar Association, and he holds a certification as a public accountant. Rick.
Thank you. I won't have to speak long before you say Georgia and Texas? Can't be. He didn't read that right, but I am a member of both of those bars, and yet I have a twang like this from back in New York, where I spent my childhood. Well, it's interesting, Jerry, I thought you did a phenomenal job. And usually when I talk about this subject, I usually have to go back and give some of that sort of background so people really can appreciate, what was the financial crisis really all about? And I thank Jerry he sort of did a great job of describing what ultimately was sort of a perfect storm of many things that came about. But the high points of, we had this rise in real estate. You could attribute it to whatever you think it was. Maybe, the two-wage earner family, I think, helped drive it up. Low interest rates helped it drive up. There was just a policy, a desire to have a policy in the U.S. that we wanted home ownership. Through a number of administrations, we can look back. And then Fannie and Freddie, as Jerry described, these were originally, they are government-sponsored enterprise. They were created by Congress years ago to give liquidity to the mortgage market. Because when you think about a mortgage loan, it's a 30-year instrument. And the borrower always has the option to repay the loan anytime, so they can refinance for a low loan. Very difficult asset to manage, right? Because it's always, you're putting it out there, you may get the money back as a credit risk, but more importantly, it's a 30-year instrument, so very difficult. And that's our housing finance in this country, is 30-year fixed-rate mortgages. That's what people wanted. We do have adjustable, but that's not what people would favor. So you kind of set that up, and then you look at the world as a whole. We have this glut of liquidity. There are all these institutional investors, insurance companies, pension funds, sovereign entities across the world, all looking for, good investments, safe investments. But they're also looking for yield. And with all of that demand, a lot of money chasing too few good investments, they sort of all seized on this asset-backed security, which Jerry described, the mortgage back. And there was all kinds. There's commercial real estate, there's credit card receivable securities, but this whole concept that Jerry described, that's what was out there. And we were sort of perfecting that market, and you could see how you could improve the credit rating of instruments simply by using the structure of the instrument to come out. It's all about cash flows and who gets them first. And if you're got these cash flows coming in every month and you're on top of the waterfall, you're getting paid first. Of course, you're only earning, say, 1.5%, while the guy near the bottom is earning 9%, but they take the first risk of loss. So as the money flows in, this gets paid, they get paid, they get paid. On the bottom, it's very risky. And as Jerry described, we brought that to a whole new level when we decided we'd start taking cash flows off those tranches and create a whole new security that would then produce cash flows, and we would rate that. Well, at the same time, there was all this demand for these securities. We start seeing everyone who wants to securitize this stuff dropping underwriting standards, ignoring their risk and auditors internally, because they just need product. There's such a demand for the security, we just need these mortgage loans. And hence why our agricultural worker making $14,000 a year gets a $700,000 house, kind of stuff. And there was also a lot of greed. You had all of the salesmen behind those mortgage originators. They were used car salesmen before they were mortgage originators. And now they're making 6 figures, some of them making 7 figures. Of course, they're encouraging all of these borrowers, you can buy that $700,000 home. Don't worry, you don't need to report the income. Or here's what I would say you would need to say your income was, but I'm not telling you to put that there. So a lot of that stuff went on and created, just this huge market, a huge demand for these securities. Hence why when it all came to an end in 2008, actually started the crack in the dike was really, the start of it was 2007, early on. If people remember, it was subprime only. Oh, we had a subprime lender go down in California, and everyone thought it was going to be held exclusively. This is all about the subprime securities. Well, then that bled into the prime securities, including not this stuff, the low income, low doc, no income, no job, ninja loans that we talked about, but started bleeding into really normal loans, 80% loan to value. It starts to bleed in, and then you can't stop it. And ultimately, we end up with this crisis come 2008, and we are illiquid in this country. Actually, we're illiquid almost across the world. We have a situation where we can't even get banks to lend to banks. And when that happens, everything comes to a screeching halt. And that's where we were. Okay, you look and say, now time goes on, we finally get through that crisis, the Fed comes in, there's all this intervention by the government to figure this all out. And it's with a lot of risk, too, I would say, to some of the people, decision makers, the policy makers back in Washington, because the question first came, what do we do with Bear Stearns? That was the first one. And the answer was, well, they looked and said, you know what? We let Bear Stearns go down. And with that, it's going to bring this, and this with it. And we can't afford to let all of that just implode. So we need to intervene. And they got J.P. Morgan to take it over, but they guaranteed $30 billion worth of assets for them to take it over. Tremendous criticism. This is where the politics come into play. Oh, criticizing that, you should have never done it, you should have let it go down. And I just think the general public doesn't appreciate, certainly the politicians didn't, that you just can't do that. Well, then we get, then we go to Lehman Brothers. And now we've learned a lesson with Bear Stearns. Oh, we better not provide any assistance or intervention. So we let Lehman go down. And that's really what brought us to our knees in 2008. Quick lesson learned, we can't do that. It was too big to fail. And it wasn't Lehman Brothers, remember. Neither Bear Stearns nor Lehman Brothers, that's not a federally insured depository. The government really didn't have to intervene like it would if it were a large financial institution that it also has deposit insurance responsibilities for. And that's what happened. What you saw in that illiquidity is companies that spent years of their existence staying away from being regulated by the Federal Reserve, now coming to the Regulatory Reserve and said, if I can access the discount window, if I can get liquidity, I'll go ahead and sign up to be regulated. And that's where we stood. We finally come down to a point now, it's time for a new administration to address the issue, and we come up with Dodd-Frank. We're going to reform, the financial system as well as our banking system. People ask all the time, what do I think of Dodd-Frank? And I can say there is some good things that have come out of Dodd-Frank. But I think generally I would tell you from my experience, it was a very rushed piece of legislation. And the politics were tremendous because it was just a one-sided deal. That one party said, we're going to pass this thing, we need to pass it. And sometimes you have to pass a bill to know what's in a bill, as you know. And so we passed this huge piece of legislation to address all these issues and fix all these problems. I'm not sure we really understood what the problems were. If we had known then what Jerry presented today, I think we could have probably taken a better approach to some of this, but we didn't. So in Dodd-Frank's, there's actually a requirement for like 87 studies. I think we should have done the studies before we passed legislation to fix what those studies would tell us was, would cause the problem. And so that's what I would tell you. It was, I think, well-intended, as these things always are, but the consequences weren't well thought out. All of those fixed that Dodd-Frank, we'll cover some of them, put in place, nobody stopped to say, well, if we just kind of do this now, we do it hurriedly, what's the effect going to be? What's the effect going to be on credit? Is it going to stymie credit? Because that's what, in the past, if you've seen, we go through these cycles where the pendulum is just, caveat emptor, and then it all falls apart, and we swing way back, and now we regulate to the nth degree. And what that does, it cuts off credit. And this country runs on credit. And so that's what the first thing is. What does Dodd-Frank do? It helps already a situation where credit was being restricted because banks were concerned about the losses they were going to be taking, but it creates tremendous uncertainty. So now a bank says, I don't even know what my capital is going to be once they pass all these rules. And even Dodd-Frank didn't set capital standards. They said to the regulators, here, you need to set capital standards, but we think they need to be higher, and they need to address this and this. And so anyway, we end up stagnate. We put a chokehold on credit. We end up, creating tremendous compliance burden on banks. And the worst part of it all is it falls on all banks, including, like in the state of Washington, our community banks, right? Who I assure you did not participate in any of what you saw in Jerry's presentation about creating those loans that built those securities. It just didn't happen. Our problem in Washington state was we had a robust economy in many parts, even out here in the eastern part of the state and back in the western part, Everett, Seattle, Tacoma, and we just had a lot of construction going on, and we had banks that got too concentrated in residential construction development type of lending. We've seen that before, and that was generally our problem here. But overall, what Dodd-Frank ultimately did was it threw more cost, more burden, compliance burden on banks. It created tremendous uncertainty, and not just in the banking industry, but across many industries. And you know, with all of that, we end up in this, what I described today, and I described it, I guess I started talking about this 3 years ago. Before that, 5 years ago, and I was still at the Federal Home Loan Bank. We're in this sort of bump along economy. You know, ooh, good thing, bad thing. Oh, here, good thing, bad thing. The bottom line is we're going to be in this for a long time unless we get people back to work. It's what drives the economy in America is jobs. And when that happens, we'll start to see some of this. And the question is, can we have that? Can we have that as we're busy, you know, fixing the causes of the financial crisis? If you look at Dodd-Frank, and let me just give you an idea of how comprehensive this was. There are 398 rulemaking requirements in Dodd-Frank. 50% have final rules, 22% have been proposed, and 28% have not been proposed. All of Dodd-Frank statutory deadlines have passed. There were 280 rulemaking requirements with deadlines. 132 deadlines were missed. 148 have been met with final rules. There's been no action on 56 out of the 132 missed rulemaking deadlines. This is, how do you operate in uncertainty? How about if you show up to class, day one, professor says, I got a syllabus, but I'll get it to you in a couple of months. I definitely think there's a book that would go well with this class, but I'm still looking at a couple of them. I'll let you know when I figure it out. And, you know, oh, by the way, we're definitely going to have tests on a regular basis. I'll get back to you when we're going to do that. And I'll even tell you what's in there. I mean, that's what we did. That's what we did to our banking industry. We just, nobody knows what to do. So what do? They hunker down and they hold on to their capital. They don't make loans. They don't make loans. People don't, you know, it's particularly loans to small business in Washington State. But despite all these huge corporations we have, reality is majority of people work for small business in the state of Washington, if you take out the government and the federal government and the state. So you kind of look at that. You need to supply credit, and that just wasn't happening because of that. These just another showing of the statutory requirements, how it's not just, the burden just didn't fall on the bank regulators, but it fell on the SEC, the Federal Reserve, the CFTC, the CFPB, and we'll discuss that in a minute. That's the Consumer Financial Protection Bureau, FDIC, and then many of these new rules and regulations had to be promulgated across more than one agency in some cases, and you can see that. And then finally, just what did Dodd-Frank address? And that's kind of, I don't know if you could see that, it's a little dim here, but the largest chunk of this, 29%, was addressing derivatives. And so we'll kind of start with that, I guess. Based on what Jerry just said, you would think, well, they needed to address derivatives. It's obvious that was a primary culprit in all of this crisis. Okay, they absolutely did. Because why? Because we at one point in time, we had more credit default swaps, you know, derivatives, financial contracts covering the risk of a default on borrowings, mortgages, credit cards, whatever. At one point in time in this country, we had more credit default swaps than we had in total credit out in this country. So we had reached the point where people were just speculating. It was, you know, you could go to Las Vegas or you could buy a credit default swap, either one. It's gambling. And that's what we did. And so clearly Dodd-Frank had to address this whole issue of, okay, we're not interested in this speculative type of derivatives. At the same token, derivatives are important instruments to manage risk in financial institutions. And so we can't just throw the baby out with the bathwater. We have to seriously look at this and figure out what it is we don't want our financial intermediaries involved in. And the good derivatives are, for example, interest rate swaps that help financial institutions manage their interest rate risk, right? Because if you go out today and you make a lot of loans at today's low interest rates and they're all sitting on your books, what happens when rates rise? Well, if you don't have a derivative, if you don't have an interest rate swap in place, you're going to lose your shirt. You probably go out of business. So there are actually good derivatives and bad, and we needed to take the time to understand those differences, and we needed to carefully carve that. So Congress, in this case, Dodd-Frank, we punted to the regulators, and we do have some rules out. And through the comment period, we have carved out some. But this is huge because we're actually creating an entire separate market for all of this. So we're going to treat this like we do commodities in this country, creating an exchange and swapping it. And the question is, okay, what are the costs involved? And at the end of the day, will all of that cause these instruments not to even be desired going forward? The good ones, not talking about stopping the bad ones. Anyway, I'll kind of just run through. We did have, and a big piece of this was stability. And I think Jerry made a great comment about, it's one thing to go in and look at the institution on an individual basis. And we do that in my department. That's what we do. We examine banks, right? So we go in and individually look at a bank. At the same token, we're also responsible for systemic risk across the state. And so I think that was an important piece in Dodd-Frank, again, punted to a lot of agencies, but we do need to understand the implications of having these large financial institutions. When I say that, I'm not just talking about banks. I'm talking about financial institutions. I'm talking about systemically important, SIFIs, systemically important financial institutions. So just creating that concept and saying we need to better understand the impact some of these large, maybe they could be insurance companies, they could be banks, they could be investment banks, could be a number of different companies that would qualify as that, but we need to understand the impact if they don't survive. And so that's a concept that came out of Dodd-Frank. I think a good one, and they're working on it. Another piece came out with stress testing our banking system, the very large institutions that the government does have some responsibility on the deposit insurance side for those. They created the living will, which is hey, we want to know how you're going to take this company apart should you get into trouble. They're working on capital requirements. Unfortunately, like I said before, if a banker doesn't know what his or her capital requirements are going to be, when all of this is done, and you saw that we have a lot left to do, even years out, again, they're not going to lower their capital by lending. Every time they make a loan, they reduce their capital ratio, and unless they know what their capital ratio is going to be, they're going to be reluctant to make the loan. So anyway, I think that we also went after the foreign banking organizations operating to level the playing field. So those are the good things, I think, coming out of Dodd-Frank. There's also resolution planning, which is, hey, FDIC does a pretty good job now liquidating the failed depositories. How about some of these, larger organizations? Maybe we put them in charge of that as well. And so FDIC takes on the responsibilities for orderly liquidation. There's also a concept in this and we talked about this at lunch with some students. Dodd-Frank intended to address with these rules too big to fail. The concept that a small community bank, like we have a lot of here in Washington State, serving our communities, that's easy to close. The bank's broke, close it. Well, it's interesting when you look in the crisis, a bank the size of Wachovia was one, a very large national bank that should have been closed. Well, we couldn't. We couldn't close it because if we closed it, what else would we bring down with it? Very much like the Bear Stearns, only Wachovia had deposit insurance. So there was real risk of loss, to the government in that case. So anyway, I think I think the whole concept of too big to fail is something that we can try to continue to address it, but I'm not sure there is a solution, to it. So, but that's what much of that orderly liquidation was intended to do. We have then sort of agency oversight. There was a shuffling of responsibilities amongst the agency, and then the creation of the CFPB. I kind of like the CFPB because I'm also a consumer besides the director of banks. But at the same token, I'm not sure we should have created a whole separate agency and given them responsibility while we still left all of the responsibilities for consumer rules and regulations with the federal agencies. So it was already with the Fed. And in fact, many of the things the CFPB is doing now is simply adopting what already exists at the Federal Reserve, but wasn't enforced. And so anyway, my only gripe with the CFPB is I'm not so sure it made a lot of sense to create a separate agency, sort of double the effort. I think if you're going to create the separate agency, then you take the responsibilities away from the others and you put it all in one agency and you don't double the cost and double basically the regulation of that. But they've done a lot of good things, CFP. They are the ones that will look really to address some of the issues that, like on a systemic basis. Again, at lunch we talked about, one of my pet peeves, having watched that whole mortgage, business implode, was student loans. Something near and dear to all of you. But I kind of watched that from the sidelines, and I saw some of the same shady characters that were in the game here, in these securities, looking at small, struggling, accredited colleges and universities. They come in and they buy and they turn it into a business. And reality is, it's not about the education; it's about helping you all finance your education and securitizing those loans and selling them to the Department of Education, selling them with a guarantee from the Department of Education. So anyway, they're into that now. So I actually think the CFPB and giving them responsibility beyond just repeating what the banks do, it was a good thing. At the same token, when you start changing all the rules, and when you start changing the rules for the community banks who didn't really cause the crisis, all you do is layer more cost, more compliance. So looking at this chart here, I threw down statistics of what does this mean to an average community bank, like a Washington Trust or a Washington Federal or a Columbia Bank that you have here in Pullman. Okay, well, they have to deal with 16,000. This is just with what's been accomplished. There's still more to come, but this is to date what's been accomplished. They've got the average community bank has 16,000 pages of new regs, 245 new regulatory items to deal with. They spend an average on compliance now, added on to what they were already doing, about 3,400 hours to a cost of additional somewhere between $150,000 to $200,000 a year in additional cost for that. And they added 2.2 employees. That's the good part, I guess, they're employing people, so there's something out of it. But all of that is the point is, you need to be more cautious, I think, thinking through this and say, well, listen, we don't want to punish the people that didn't really help cause the crisis, but unfortunately we don't do it. And so all of you as potential policymakers going forward, you need to keep this in mind. We shouldn't move forward with policies until we fully explore the unintended consequences of some of this. So anyway, to finish off some of these other areas, investor protection. I have to tell you, I'm sort of like, we had investor protection in this country. Maybe what we needed to do in Dodd-Frank was rethink whether simply disclosure is the way to go. Maybe banking supervision is unlike, say, insurance and unlike securities, right? So banking supervision is prudential. I describe it as like Mother May I. Banks operate under tremendous regulatory scrutiny and have to ask permission to open a branch, close a branch. They have ratios they have to meet. They have maximum concentration levels they live by. You look at sort of how we do insurance in this country, I call that the find and fine methodology. You see that they're violating the insurance laws, you fine them, and that's how that works. And then you have securities, and that's just disclosure-based. So the concept in securities is you have to say everything about this, and if you've done that, you've met the letter of the law. So if you say, hey, this is a Ponzi scam, and I'm intending to take your money, and it's in that offering document, you've met your burden, right, under the securities laws. So it's really different types. So we really should have thought about whether we should continue to regulate the securities industry and these investments with just simply, disclosure type of an approach. And maybe we had to rethink about maybe there should be more in terms of more prudential supervision of those. And I think I might leave it there because I'll leave some for Jim, and then I can respond to questions if we could.
I know a few of you have to leave for a class, so. Our final speaker is Jim Barth. Jim is the Lauder Eminent Scholar in Finance at Auburn University. He is also a senior fellow at the Milken Institute and a fellow at the Wharton Financial Institution Center. His research focuses on financial institutions and capital markets, both domestic and global, with a special emphasis on regulatory issues. Dr. Barth has held positions as a professor of economics at George Washington University, as an associate director of the economics program at the National Science Foundation, and is the Shaw Professor of Banking and Finance at Nanyang Technological University. He has also been a visiting scholar at the U.S. Congressional Budget Office, the Federal Reserve Bank of Atlanta, the Office of the Comptroller of the Currency, the World Bank, and was one of the leaders of an international team advising the People's Bank of China on banking reform. Dr. Barth was appointed by Presidents Ronald Reagan and George H.W. Bush as the chief economist of the Office of Thrift Supervision, and previous to this, served on the Federal Home Loan Bank Board. He has testified before several U.S. congressional committees and has authored over 300 journal articles. Dr. Barth.
Thank you. It's a pleasure to be here with my good friend David Whidbey and Wenling Liu. Having listened to Jerry and Rick, you're probably wondering what I'm going to add to the conversation. What I'm going to do is talk about something perhaps that neither one mentioned, and I did have the opportunity to work at the same agency as Rick, so we had an opportunity to talk a little bit about our past and some of the institutions got in some trouble, which was very interesting. Not going to talk about what we talked about, but I'd like to make I only have 2 slides, and then I'm going to just mention a few points to make some comments, I guess, related to what Jerry said and what Rick said. First of all, I have a slide here showing you some information on banking crises. Okay, the frequency and severity of banking crises in countries around the world. So Jerry and Rick talked about the United States, but we had many banking crises in many parts of the world and in countries at all levels of income. It would be nice if we could find that banking crises only occurred in low-income countries or only perhaps in African countries. That's not the case. They've occurred in countries, again, in all parts of the world and all levels of income. So there's no magic solution to preventing banking crises. The second slide I'll show you, which is a slide that just focuses on the United States. Now, I think with Wenling's help, I've gone all the way back to 1790, and I've identified here all the major pieces of legislation that deal with the banking sector. And if you look closely, I do have the Dodd-Frank Act, which Rick talked about, and I'll say something about that in a few minutes, which was enacted in July 2010. And you go back in time, you'll find out that every major piece of legislation that deals with the banking sector, apart from 2 or 3 pieces of legislation, follows a banking crisis. So our country has not been good at enacting legislation to prevent a banking crisis, but once we have a crisis, then we enact legislation. And every president, including President Obama, when he signed into law the Dodd-Frank Act, uses 2 words when he describes the legislation. He says, with this piece of legislation, never again will I have a banking crisis. And then we wait roughly 20 or 30 years, and we have another banking crisis. So in every one of your lifetimes, you're going to encounter a banking crisis, just as some of us has, okay? You'll have to wait perhaps 20 years now or so for another banking crisis. It turns out, Rick mentioned the length of the Dodd-Frank Wall Street Reform Act. It's longer than the act that established the central bank in this country, our Federal Reserve System. That law was, I think, 13 pages in length. This law, the Dodd-Frank, was over 1,000 pages in length. So what do we get over time? We get more laws and regulations, and we get more regulatory agencies. I was going to put up a slide, I don't have it with me, showing our regulatory structure. We have too many regulatory agencies that we actually do need. We could probably do away with some, but that's extremely difficult to do. So again, we get more laws and regulations, and we get more regulatory agencies. Rick mentioned the most recent one, which is the Consumer Financial Protection Agency, which came about as a result of the Dodd-Frank Act. That's the most recent new regulatory agency. Let me mention a few things. First of all, and I'm going to do them in no particular order, things that occurred to me, because I knew when I went last that Jerry and Rick would do a pretty good job talking about regulation, talk about the problems in the housing sector, about which I have probably a 150 slide deck. I think David's seen it, dealing with the housing crisis. I think what he did was a very good job, as Rick mentioned, talking about the crisis. One thing, if you go back to 1790, you go back over the past 120 years or so, housing prices went down in 40% of those years. They went up in 60% of those years. So if you have a business model that assumes prices, housing prices only go up, it's a flawed business model because it's based on an unrealistic assumption. So regulatory authorities, as well as participants in the housing sector, should have taken into account that home prices might have gone down. So again, we had a lot of business firms operating on flawed business models. The second thing I'll mention is credit rating agencies that rated a lot of the mortgage-backed securities that Jerry talked about, that were backed by subprime mortgages. It turns out that if you buy a security that's rated AAA, okay, you're paying the highest price and getting the lowest interest rate. It's foolish, in my view, to ever buy a AAA rated security. You're assuming the rating agencies have done a pretty good job because, again, you're paying the highest price, getting the lowest interest rate. Some very wealthy individuals that I've happened to be around tell me they always buy securities that are rated at a much lower than AAA rated. Why? Because you get a higher interest rate and you also have the opportunity for an increase in the price of that security, meaning you get a capital gain. So why do you trust the rating agencies? When they started out rating securities, they were basically charging the people, the investors who wanted to buy securities. Now the model that Jerry was talking is one in which what they do is they charge the firms that wish to sell their securities. So there's a potential conflict of interest. And a good portion of the revenue that they were getting as they're rating the securities and getting revenue was also in the form of consulting fee that their consulting fees are getting from charging the firms for the securities which they're rating at the same time. Okay, a conflict of interest. And who was overseeing what they're doing? The SEC. And I agree with Rick when he talked about community banks. Community banks make about half of all the business loans in this country, even though 5 of the big banks in the United States account for just over half of all the banking assets in the United States. So community banks weren't, by and large, the problem that we had in the banking sector, but they're very important for small and medium-sized businesses. So we want to preserve the community banks. So they're caught up in the Dodd-Frank legislation. Talking about cost-benefit analysis, Jamie Dimon, who's head of JP Morgan Chase, was at a conference, a Federal Reserve conference, and Ben Bernanke, then chairman of the Federal Reserve at the time, was asked a question by Jamie Dimon. He said, can you tell us what the costs are with all the regulations that are flowing from the Dodd-Frank Act? And he said, it's too complicated for us to know, and I'm not sure we'll ever know what the true costs are. And yet, you're supposed to do a cost-benefit analysis. That's what's typically taught in economic courses at universities like Washington State University. But we didn't do that, and Rick mentioned that point. The other thing I'll mention about the Dodd-Frank Act, the biggest enemy of well-functioning financial markets is uncertainty. You go back to the 1920s, and there's a Chicago economist by the name of Frank Knight. He made a distinction between risk and uncertainty. Risk is something you can measure. Uncertainty you can't. So what Rick was talking about, there's a lot of uncertainty. So what do? You pull back. You don't invest. Corporations are holding $1.5 trillion in cash here in the United States. And it turns out banks are holding a lot of excess reserves. How do you deploy that cash if you have a tremendous amount of uncertainty? You don't. You tend to sit on the cash, which doesn't promote economic growth. Now, let me mention my view, which covers some topics that weren't mentioned by either Rick or Jerry, and that is the role of the regulatory authorities. And I'll excuse Rick, okay, from everything I now say, okay, and his role here in the state of Washington, or my role, his role in Washington, D.C., and that is the regulatory authorities. Jerry mentioned credit default swaps. It turns out the Federal Reserve Board allowed banks to leverage to a greater degree than they otherwise could by using credit default swaps. What does that mean? If it turns out that they made a loan, they could take out a credit default swap. In the event that that loan declined in value, a firm like AIG would cover the losses. It turns out if AIG had a AAA credit rating, the Federal Reserve told the bank, you can hold less capital, and zero nothing against that loan. So they leveraged more than they otherwise would have. And nobody was regulating AIG. As you know, AIG was bailed out by our federal government. I fault the Federal Reserve. A bad job that it did. Shame on the Federal Reserve, okay? And Ben Bernanke and Alan Greenspan. The second AG, SEC. SEC's mission in life was to make sure adequate information, all material information, was disclosed to investors before they buy publicly traded securities. It turns out SEC basically was overseeing 5 major investment banking companies, and Jerry mentioned them. 5, okay? We have 2 left. Bear Stearns was bought by a big bank, which became bigger, okay, after it acquired Bear Stearns. Merrill Lynch was bought by a bank. It became bigger after it bought Bear Stearns. Lehman Brothers failed, was allowed to fail in September 2008, and Jerry mentioned that. And that was the time also the federal government decided to bail out some of our banks. And a good point that Rick made is at that time, banks were unwilling to lend to each other, basically. When banks won't lend to one another, you know there's a problem, okay, because they know more than the rest of us. It turns out, then the government bailed them out. It turns out that the SEC, though, was overseeing just those 5 major investment banking companies. So it turns out they basically had 5 individuals assigned the task of assessing the riskiness of those 5 big institutions whose total assets exceeded the assets of many countries. They did a particularly lousy job. Okay. They even shut down some of the offices within the agency that were trying to undercover the riskiness of the investment banking companies. It turns out that the FDIC, when you look back, you find out that the examiners of SIC, the supervisory people, actually identified 90% of all the problems at all the institutions that were subsequently either subsequently failed or bailed out by the government. And yet they did nothing about it at the higher levels of that agency. And Sheila Bair, actually, I tend to be somewhat of an admirer of her, but yet her agency did a particularly bad job of dealing with institutions, other than the community banks, the smaller institutions. It turns out Freddie Mac and Fannie Mae were regulated by an agency called OFEA. It was on one of the charts. Okay, that agency, a federal agency, only had to supervise and monitor 2 institutions, and it did a particularly lousy job, both of which were put into conservatorship. The Secretary of Treasury, 2 months before they were put into conservatorship by the government, bailed out effectively, said those institutions are in pretty good shape, and we have no intention to bail them out. Okay, do you think he didn't know that they were in terrible shape and they would have to be bailed out? It turns out that the Dodd-Frank Act, I testified before the House Financial Services Committee on the Volcker Rule, which basically Rick talked a little bit about. I couldn't quite tell his view. It's an attempt to tell banks you can't engage in derivative activities if it's for speculative purposes versus non-speculative purposes. How one's going to determine that, I'm not quite sure. Okay. Also, he's quite right with respect to what's called the Orderly Liquidation Authority. It's an attempt to deal with big banks. And I told you, 5 of our institutions, big banking institutions in the United States, control just over half of all the assets. And there are almost 7,000 banks, Rick, here in the United States. Over 7,000 banks, basically. 5, and their bank holding companies actually control just over half the total assets. It turns out some people say we should break up the big banks. The president of the Federal Reserve Bank of Dallas and some others, MIT economists, I was supposed to debate actually in Chicago, and he didn't show up. But it turns out, not because of me, incidentally, he wasn't intimidated, but he is interested in breaking up the banks. But the problem is it's not clear how one can go about breaking up the banks in the United States or any other country. After all, the regulatory has allowed them to become bigger over the years, okay, by acquiring some of the investment banking companies. And 2 of the investment banking companies, Goldman Sachs and Morgan Stanley, converted to bank holding companies. And therefore, they too now are covered to some degree by the safety net they can now borrow from the Federal Reserve and so on and so forth. So in my view, a lot of the problem was caused by the regulatory agencies. They didn't do their job. They failed us, okay? The citizens of the United States, the taxpayers of the United States. They did a particularly lousy job. And I and my co-authors, I have two people, one at Berkeley and one at Williams College. We wrote a book called Guardians of Finance, an MIT press book, and we've presented it, talked about it at different places in this country and other countries. So it does turn out that what they didn't talk about, and I'm not sure if they totally agree, is that regulatory authorities failed us in basically taking strong action against institutions in a timely manner. And in the book, we go into great detail. Where we got the worst audience, okay, was at the Federal Reserve Bank of New York. Excruciating. But at the time, it was the person in charge of the meeting was the head of supervision at the. They thought we were a bit too harsh. I'm not going to tell you our solution dealing with the problem, but I think now under Dodd-Frank, the net has been stretched. It turns out the regulatory authorities now can go throughout the financial sector and identifying SIFIs, as Rick put it, systemically important financial institutions, potentially hedge funds, insurance companies. Now, if they didn't do a particularly good job throughout the history of the United States in preventing the next crisis, do all of you really have confidence that by giving them more powers, more authority to go throughout the entire financial sector, trying to uncover problems and preventing problems in the future, that they're going to be successful? I mean, the history is they haven't done a particularly good job. And I was there, Rick is there, okay? But again, I would warn you that perhaps we can't be really sure that things are going to never again take a turn for the worse in our financial sector. I'm not so sure that we won't have still institutions that are too big to fail. I'm optimistic. I like to be an optimist. I don't want to be a pessimist saying everything's going to turn out bad. But I think we have to realize that the fact is that we have had problems in this country, many countries. No country has gotten it quite right. I tend to spend a lot of time focusing on China. I think China's done a particularly good job of regulating its financial. As we basically were nationalizing our banks, our big banks, putting money into them, China was privatizing their banks, and they have been putting some of their banks, to the test of the marketplace by letting them go public. So again, now they have a different financial system. I'm not going to say the way we would have prevented a crisis or we should deal with the crisis is perhaps we should convert the United States to a communist country. And then we basically would have done with China, bail out its banks, but then perhaps we could control them. Most of the banks are in the hands of the government. And when Ling had a dissertation defense a day or so ago, and she talked about government-owned banks, do they make things better or worse? I won't say much more about that. But again, I tend to be still somewhat concerned that our regulatory authorities haven't done a particularly good job. And it's not the examiner supervisors. I think there's a lot of information. I don't believe that we had, as Alan Greenspan would said, or Geithner, former Secretary of Treasury Geithner, that basically there was just an accident. It was a 100-year flood. It was a bubble and nobody can do anything about bubbles, okay? I tend to take the opposite view, that the regulatory authorities could have done more, they should have done more, they owed it to the American taxpayer to do more, and they failed to do so. And at some point, we have to hold them accountable. In this book I mentioned, we have a proposal to hold them accountable, but again, it's perhaps not something that's likely to happen anytime soon. Don't forget, you have different members of Congress chairing certain committees, and if somehow we eliminate certain regulatory agencies overseeing parts of our financial system, perhaps we have to eliminate some committees in Congress. And the chairman of those committees don't have the power then that they once had, and perhaps campaign contributions, shrink to certain members. So again, all these things are related to political economics. I think with that, I'll stop because you may have some questions for some of us.
So we have a few minutes for questions and answers. I'm going to ask you to raise your hands. We have a microphone that we'll pass around. That's so we can get it on our tape. I'm going to begin with a question. We heard a lot about the failure of regulators, both in terms of creating the crisis and in responding to it. What we didn't hear very much about was clearly there were some bad actors in the financial sector and in the housing sector who were doing things they knew were wrong. They were making millions of dollars, whether you're talking about the ninja loans or whether you're talking about Goldman Sachs selling off securities they knew were junk. Have we done enough to hold individuals accountable? And if not, who should have been going off to jail or been held accountable at this point that we haven't? I'm not talking about individuals, so I'm talking about types of characters or types of actors in the system.
Well, I don't mind starting. Maybe Rick has to be more sensitive to the question. But it turns out our Attorney General in the United States said that basically at some of the big institutions, we can't go after people who engage in wrongdoing because it might create widespread problems throughout the entire financial system. Now, I happen to be quoted when that came out in several publications, and I think that's wrong. If individuals actually do engage in wrongdoing, whether it be at big institutions, certainly not just small institutions, then one should hold them accountable. And some people believe that that hasn't really happened. We haven't held individuals accountable. We may fine institutions, but what about the individuals at the top of those institutions that created some of the problems or provided this end? So I think there is a problem. Now, maybe Rick can say something.
No, it's kind of sad because we really could find some of the actors, and they haven't. But oddly enough, Dodd-Frank was passed, when do we say?
July 2010.
2010, and to date, nothing, not a single thing has been done to stop what Jerry described to us, to regulate the mortgage-backed security industry. In fact, the few things they did put in place were things like, well, the skin in the game. Hey, people have to have some equity in these homes, So we're going to create these, qualified mortgages, and we're gonna make sure that people have a down payment and they can repay the loan. So they're focusing on the borrower and the quality of the loan to fix what was just short of a scam. And and then the other piece of it, they have an exemption. It was one of the things Dodd-Frank said is, hey, you have to have retention. If people are going to do these securities, then the issuer has to have skin in the game. They have to retain some of the risk here, but we'll have an exemption. And the exemption has now swallowed the entire rule. So once again, we've done nothing to fix what is really the heart and soul of what started this crisis. So no, we haven't put any bad guys in jail, and we haven't even fixed the single greatest problem in my estimation.
Now, when a community bank accepts a loan from a deadbeat, when a community bank accepts a loan from a deadbeat, when they transfer it on, do they transfer it without recourse? And how do they get by with that?
No. So first I want to sort of make sure we're clear. I'm responsible for the 58 state chartered institutions in the state of Washington.
Okay.
We have, with the exception of 2, that they're closed because they were involved in mortgage fraud. The rest of them, the community banks, they hold their loans. They literally make you a home loan and they hold it. But for a community bank, the typical commercial community bank, they don't hold 30-year instruments. So typically a community bank would make a 5-year balloon. All right, so they would make you a loan. They'd amortize the payments over 30 so you could afford it, but the whole loan would come due in 5. And that way the interest rate could adjust up or down when they redo the loan. Well, Dodd-Frank now bans that, CFPB. No more 5-year balloon loans. So again, we kind of threw the baby out with the bathwater. We said because they were abused by the people funneling in loans to those securities, now nobody makes those type of loans, and yet that was kind of a bread and butter product for a community bank and the way they could manage the interest rate risk on that product. But what we did have was we had large national banks that formed mortgage subsidiaries that were feeding these securities. And so they were doing that under a notion, a theory that the control of the currency had on federal preemption, saying that if a national bank has a subsidiary in a state, making mortgage loans, the national bank's rules apply, not the state's mortgage rules. So one of the good things that came out of Dodd-Frank is now all mortgage originators are licensed. And so when we have a bad actor, someone that's encouraging people to falsify information in a loan application, helping them cook their application, or if they are putting people into houses they can't afford, or they're not checking to ensure that they can repay the loan, well, when they get thrown out and they get their license taken away in the state of Washington, the 49 states now know and won't issue them a license. So that is a good thing that has come out of Dodd-Frank. Everybody is licensed, but it was actually the SAFE Act that licensed it, but the concept came out of Dodd-Frank.
But in the bad loans, though, if a community bank or any bank makes what you call bad loan, deliberately bad, and they don't disclose that information, somebody else that buys, there's a potential of a legal suit. A lot of institutions are being sued today. Banks and others are being sued because of what you're talking about. They made a loan that didn't comport with the characteristic loans that they told the buyer about. So bad loans per se, you can take recourse against the bank that makes, if it's a deliberately bad loan or fraudulent bad loan.
The guys who are buying those loans don't know whether they're good or bad. Why don't they require that some
They do.
They allow themselves to have recourse?
What they do is they can go to an insurance company. It's called a monoline insurance company, which provides insurance. The monoline insurance tries to make sure the loans have certain characteristics. If they do not, okay, then the insurance company or the buyer of the loan can go back to that institution and say, you purported to be selling us loans with certain characteristics. They don't have that characteristic, and that's the recourse they have through the courts, basically.
It wasn't that the securitizers knew. They their own people were well aware that the stuff they were buying to securitize was not meeting their underwriting standards, and not meeting the very standards they put in their offering documents. So you have these lawsuits out there now, and the stuff that's being turned up in emails is just unbelievable. Bear don't care to send a loan. The most recent one I just saw recently, it was just, I was flabbergasted. The mortgage originators had done a script because they were getting a lot of heat from, the risk people, right? The quality control people. So they passed around this script that took that scene out of A Few Good Men between Jack Nicholson and who was the JAG officer? Yeah, no, it wasn't Kevin Bacon. I forget. But anyway, that scene where he says, "You can't handle the truth." That they actually. Tom Cruise. They actually wrote a script for their people to use for interchange with the people trying to keep those loans, out of the securities. And reality is management just, turned a deaf ear, turned a blind eye, and allowed all that stuff to go in there.
That's all right. So, William, grad student economics. I'm glad that there's an economist on this panel because all of this is economy. Anyways, quick statement for Rich, and then maybe a question for you, Jerry. The Dodd-Frank Act, it appears since Barney Frank's district was being redrawn conservative, and he then decided to step out of Congress, that he had to please his constituents. Maybe that's why it's such a terrible policy in general. But more or less a question, Jerry. You mentioned that kind of CDOs and the such came about in the 70s. Has anybody looked at the economic effect of those over the last 40 years? Albeit hard to isolate that effect, but one could conclude that because of CDOs, the economic spillover effect would be greater than that of the loss during the Great Recession.
Well, you can point at rating failures as one indication in terms of the number that were rated AAA that eventually went into bankruptcy and things like that. And it's a huge percentage. So I think it's like a lot of things. We talked about credit default swaps. The original idea was a very good one, to provide insurance for bonds that were illiquidly traded. And basically it was a true insurance policy, which then transmogrified into a sort of a casino betting on countries and firms and things like that. And I think the same way that the idea of a mortgage-backed security was an incredibly good one, right? It allows you to buy a house at 4.5% interest, which certainly could not have been there. I think the problem is you begin to push it further and further and deliberately make it very opaque. We have a problem with the rating agency who has a direct conflict of interest, is extremely gullible about what the originator of the CDO or whatever will tell you about what's going to happen to it. And I think that whole chain, you know, the performance post 207 of all those things has been really dreadful. So I could give you a reference for what the exact returns are, but they're obviously horrible. Yeah.
You know, there are people above the regulators. Who prevented those regulators from doing a good job? Or who created the situation where they couldn't do a good job? Or why didn't they do a good job?
Oh, that's a Jim question.
You have a football team here at Washington State University, don't you? Do you know there's and they're referees. It turns out there's a book written by a Sports Illustrated columnist and also a University of Chicago professor. And what they have done, they looked at all sorts of sports in all countries at different points in time, and they find that there's what's called a home team bias. And what that means, the referees in close games, even more so, tend to be biased in favor of the home team. Now, we use that example, you know, this finding, basically empirical finding, to talk about regulators. Regulators have a home team. You know what the home team is? The financial institutions they regulate. You know what the away team is? The public, the American taxpayer in the case of the United States, except for, of course, Rick. Okay, he's objective. Okay, and knowing his background and everything that we chatted about. Okay, but it turns out they're biased. Now, how do you eliminate this bias or reduce the bias? We have. Do you know what it is in sports? Have you seen the flag thrown down and? Challenge, yeah, you can challenge a ruling of an official. Guess what? That bias has been reduced. We don't have a way to challenge the regulatory authorities. If I speak out or Jerry speaks out or any faculty member at Washington State University and says, we think the regulators aren't doing their job. They're allowing these ninja loans, no income, no jobs, okay? The people in that situation to take out a mortgage, the example that Jerry gave and what Rick mentioned. It turns out that if I say something as an academic, a lot of the regulatory authorities, this individual doesn't have the information that they have. And they have more information than we do. At the Federal Reserve, the OCC, all these regulatory agencies, Rick has more information about the banks than I do as an outsider. But the point is, are they using it right way? We can't easily challenge them. So again, maybe we need this sort of ability to challenge. We need some agency that can now and then challenge the regulatory authorities. But again, you're quite right. I don't think the regulatory authorities are evil people. I don't think they deliberately are trying to cause crises, okay? And I want to make that clear. I think things do happen, but they may be biased. Then it's just human nature. And when I was a regulator in Washington, the people from a lot of different financial came to visit the agency. I would meet with them. I'm sure they talked to. You want to get information from them. So I don't think regulatory authorities are bad people, but it may be there's this home bias. You tend to listen more. The Federal Reserve, if you look at the meetings and they meet with the public versus the big financial institutions, most of the meetings with the public have diminished in number. Most of the meetings with the big institution, particularly during troubled times, go up in number. So again, maybe they just have this built-in bias, just like regulators did without the ability to challenge.
So in that sense, they're dominating the regulators.
Influencing. Maybe sometimes unduly.
Can I ask one other question? What do you think about the Glass-Steagall law? Was that a good thing to have eliminated it?
A bad thing in my view. I'm not in favor of going back to the Glass-Steagall. What this is it basically separates commercial banking from investment banking. Some people say that caused the financial crisis. I think that's nonsense. Okay, totally misguided to go back to where we were with Glass-Steagall. And I think somebody said that a derivative is just a financial instrument. It can be misused. You don't want to eliminate derivatives. You don't want to eliminate mortgage-backed securities. You want to eliminate the misuse of those tools. They're financial tools. And every other country China included, allows the mixing of banking and commerce to a greater degree in the United States. They allow basically the mix of commercial banking, investment, and banking. I don't think that caused the problem.
And the Volcker rule goes towards fixing, right? That whole notion of not having proprietary investments, while at the same time you have this investment arm selling to customers, right?
Yeah.
So the Goldman Sachs, at the very time, Goldman Sachs is actually betting against the very instruments they're putting their customers into, right, to make money. And so going forward, that shouldn't happen. But it's funny, I think people need to go back and really study Glass-Steagall. Glass-Steagall came about really at a point in time we were more concerned not about this issue of mixing investment banking and banks. It was mixing commerce and banking. It was, should Ford Motor Company own Citicorp? And if we ever let that happen, then Citicorp will never make a loan to GM or Scion or anyone. So it was an allocation of credit issue is what really brought that all about.
You have our associate dean here was going to ask a question, and I'm curious to know what his question was.
Okay, we have time for one last
I'm pretty sure we're out of time.
I'll ask it really, well, mostly I was actually, I'm not going to ask a question because it's.
Go ahead, make a comment.
No, I was going to, first I was going to tease Jim because I feel like in the interest of disclosure, before he criticized a bunch of regulators, he should have disclosed the fact that he, as well as me, and I think Rick as well, used to work for one of the only federal agencies that was ever eliminated. And so he's just bitter. So that's.
But what he didn't say, okay, the only thing he didn't say is that when we went to that agency, we were helping to resolve the problem. It was already a well-known problem. So we were helping to clean up the mess, David. You forgot that.
I'm afraid our time is up, but I'm going to invite you. We have a reception next door, and you can come speak to our guests at the reception. There's some wine and cheese and some soft drinks. And now I'd like you to join me in thanking our guests for a wonderful panel. Again, I want to thank the College of Business. And those of you who may be here for a class, there's some sign-up sheets over here. Thank you again.